In 2026, the most expensive feeling you can own is the peace of mind that comes from owning your home free and clear. We have been conditioned to believe that debt is a moral failing and that the ultimate financial milestone is burning your mortgage papers. Your parents, your Dave Ramsey-style gurus, and your own anxiety tell you the same thing. Pay off the house as fast as possible to be truly free. They are lying to you. In fact, if you follow this standard advice, that extra $1,000 a month you're throwing at your principal isn't buying you freedom, it is incinerating millions of dollars in potential wealth. Today, I am going to prove to you with brutal, cold-blooded arithmetic that paying off your mortgage early is a mathematical disaster that keeps you vulnerable, illiquid, and significantly poorer over the long run. We are going to expose the hidden math of opportunity cost, the trap of home equity, and the reason banks are secretly thrilled when you send them extra cash. You aren't destroying a debt, you are destroying your future leverage. The reason you fell for this trap is rooted in a psychological phenomenon known as loss aversion, combined with the debt-free cult narrative. Humans are biologically wired to fear what we owe. The system exploits this fear. It markets the mortgage-free lifestyle as a form of safety, but it never mentions that home equity is the most useless form of wealth in existence. You can't eat your kitchen cabinets, and you can't pay for an emergency with a brick. Psychologically, we view our home as a piggy bank, but it is actually a vault that only opens when you sell the house or take on more debt. This is mental accounting at its most dangerous. You've been validated by a society that views a paid-off house as the ultimate status symbol of adulthood, so you don't feel the sting of the hundreds of thousands of dollars in lost compounding interest, but you should. The system was designed to keep your capital dead. When your money is trapped in your walls, the bank has zero risk while you have zero liquidity. It is not your fault you feel the urge to pay it off. You are fighting a multi-generational conditioning campaign that prizes the feeling of safety over the math of wealth. Let's look at the hidden math that the financial peace advocates don't want you to calculate. We are going to look at Scenario A, the debt destroyer. We will call him Prepayment Paul. Paul has a $400,000 mortgage at a 5% interest rate. His standard payment is roughly $2,100. Paul decides to be responsible and sends an extra $1,000 a month to his principal. Paul will pay off his house in about 13 years instead of 30. He saves about $240,000 in interest. He feels like a champion. Now let's look at Scenario B, the leveraged multiplier. We will call him Leveraged Larry. Larry has the exact same mortgage at the exact same 5%, but instead of sending that extra $1,000 to the bank, Larry puts it into a diversified brokerage account, averaging a conservative 8% annually. Let's track the numbers over that same 30-year window. In Scenario A, after 30 years, Paul has a paid-off house worth, let's say, $800,000 due to appreciation. He stopped paying interest 17 years ago, which is great. He has saved that $240,000 in interest. His total win is the house plus the interest saved. In Scenario B, Larry pays his mortgage for the full 30 years. He pays the full interest, but his $1,000 a month compounded at 8% over 30 years has grown into $1.5 million in liquid cash. Wait, let's look at the delta. Larry paid roughly $240,000 more in interest than Paul, but Larry has $1.5 million in a bank account. Paul has $0 in a bank account and a house that he still has to pay taxes and insurance on. Larry can pay off his entire mortgage balance with a tiny fraction of his investment account at any moment he chooses. Larry has the option, while Paul only has the walls. By paying the bank early, Paul traded $1.5 million for $240,000. That is a $1.2 million penalty for peace of mind. Paul didn't save money, he lost the greatest wealth-building opportunity of his life. Consider the real-life case of Tobi. Tobi is 45 years old. He worked 2 jobs for a decade to pay off his $300,000 mortgage by age 40. He was mortgage-free and proud. Then, in 2026, the economy shifts. Tobi's industry is disrupted by AI and he loses his high-paying job. At the same time, a family medical emergency arises requiring $50,000 in immediate cash. Tobi looks at his wealth. He has a $300,000 house with 0 debt, but he has no income. He goes to the bank to ask for a home equity line of credit to pay for the medical bills. The bank looks at his application and sees he is unemployed. They deny the loan. Tobi is house rich and cash poor. He is literally sitting on $300,000 of his own money, but he can't touch it because the bank won't let him borrow against his own equity without a job. If Tobi had kept that money in a brokerage account instead of giving it to the bank early, he would have had the $50,000 in cash ready to go, plus another decade of compounding growth. Tobi is now forced to sell his dream home in a down market just to survive, all because he followed the responsible advice to pay off his debt. He realized too late that equity is just a number on a screen until you sell the asset. The bank didn't protect Tobi. Tobi protected the bank by giving them his cash when he should have kept it for himself. This is the reality check. Your mortgage is the only loan in the world where the bank gives you a 30-year fixed rate that inflation slowly eats away for you. In 2026, as the cost of goods rise, the real value of your fixed mortgage payment actually shrinks. By paying it off early, you are giving the bank expensive current dollars to satisfy a debt that would have been cheaper to pay back in 10 years. You are fighting the wrong war. To beat the system, you must adopt a liquidity-first financial strategy. First, stop viewing your home as an investment. It is a shelter with a high carrying cost. Your investment is the capital you keep working in the market. Second, understand the spread. If your mortgage interest rate is lower than the average return of the S&P 500, every dollar you send to the bank is a donation to their bottom line. In a world where inflation is persistent, low-interest debt is a massive asset. It's the only time the system works in your favor. Don't give that advantage back to the lenders. Third, prioritize accessibility. Money in a brokerage account is yours. You can use it for a business, an emergency, or a lifestyle change. Money in your house belongs to the bank until you sell the property. Never trade liquid freedom for illiquid bricks. Fourth, calculate the safety net. If you have enough in your investment account to pay off the mortgage, you are effectively debt-free. You have the ability to pay it off, but the wisdom not to. This gives you more peace of mind than a deed ever could, because you have the cash to handle whatever life throws at you, including the mortgage payment itself. Paying off your mortgage early is a scam because it exploits your moral compass to make you a more profitable and less risky customer for the bank. It turns your potential millions into a slightly smaller interest expense. You are being sold the dream of a paid-off house, so you don't notice you've been robbed of the chance to be truly wealthy. Your house is not an asset, it is a liability that you hope will appreciate. Your true asset is your ability to compound capital over time. The real winners in the financial game aren't the people with the paid-off houses, they're the people with the low-interest mortgages and 7-figure brokerage accounts. If you want to be free, you have to be willing to live with the discomfort of a mortgage balance while your wealth explodes elsewhere. The path to real freedom isn't paved with a zero balance statement. It's paved with the liquidity to tell the bank no on your own terms. But the mortgage trap is just the beginning. The same psychological fear of debt is being used by the big education system to make you think a $100,000 degree is a good debt, while a low-interest mortgage is a bad one. If you think the mathematical disaster of paying off a house is bad, wait till you see the math on the modern master's degree scam that is currently wiping out the wealth of the middle class before they even buy their first home. Stop being a good borrower for the bank. Start being a master of your own math. Because in a system built on debt, the only way to win is to use it better than they do.